Want to learn some valuable lessons from someone who's been successfully investing in the stock market for more than 10 years? Would you rather learn from my mistakes than make your own? Want to know 5 things I wish I knew when I first started investing? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. Investing in high quality stock has radically and positively changed my life. I started investing in early 2010 at the age of 27. Back then, I was broke as a joke. Actually worse, I was below broke, starting out with almost $30,000 in debt. But here we are, more than a decade later. I was able to quit my job back in 2014 while I was still in my early 30s. I'm now financially independent and living off of passive dividend income. It's a fantastic position to be in, and I put myself in this position without a college degree or a high-paying job. I grew up extremely poor in Detroit, and my job, before I quit, was working at a car dealership. So when I tell you about the amazing potential of investing in high-quality stocks for the long term, it's coming from someone who has actually experienced this potential. However, I've made some mistakes along the way, and if I wouldn't have made these mistakes, I'd have even more money than I have right now. I want to share 5 things I wish I knew when I first started investing so that you can learn these lessons from my mistakes and end up wealthier for it. Let's dig in. My first mistake was starting to invest before I fully understood what I was doing. I see this happening right now in 2021 with some young people signing up for new brokerage accounts because they're bored during the pandemic, they have a little extra cash, and the wide-scale change to free trades has become enticing. If you're buying a stock because someone online said you should, or because YOLO, or because of a headline on a news program, or because of a forum board, or because a company is run by some charismatic person, that's a huge mistake. I started investing in January 2010, and I started by buying stocks that were popular and seemed like they'd go up. But buying stock tickers based on a feeling or a headline is a recipe for disaster, and that's not investing. I don't even know what that's called, but it's not good. Fortunately, I realized very quickly that I didn't have a clue about what I was doing. Being humble and willing to admit your own ignorance is a big advantage. Well, that's exactly what I did. I then sold out of the stocks that I had initially bought, put everything in cash for a bit, and took some serious time out to read and educate myself. I learned from the greats like Warren Buffett, Peter Lynch, and Benjamin Graham. Then I went back into investing with an educated mind, a patient attitude, and a determined spirit. The lesson here? Knowledge is power. Do not invest if you don't feel fully aware of and confident about what you're doing. Stocks aren't going anywhere. There's no need to rush. Consume content, research, educate yourself. Only invest when you're fully ready. This first lesson leads me to the next one. The second lesson is this: think like an owner. Stocks aren't just digital abbreviations. A share represents a slice of a real business with real people selling real products and or services. Take it seriously. Be a business person because you're owning businesses. Indeed, if you buy stock, you should act as if you're buying a percentage of a business. That's exactly what you're doing. If you wouldn't want to own the entire business, why own even one share? So before you ever buy a share of a business, you should be doing your research. What's the business model? How does it make money? Where does it make money? What is the growth rate? How much debt does it have? What are its margins? What's the valuation on the business? These are basic questions that you should be able to answer about any business that you own a slice of, because I can guarantee you that if you owned the entire business, you'd know all of this information intimately. Here's the third thing I wish I knew when I first started investing. Don't chase yield. I've made this mistake a number of times over the last decade of investing. While a high yield can be tempting, it's often a sign of trouble. There's nothing great about a 10% yield if the dividend is thereafter cut, the stock falls dramatically, and you're left with only a small portion of the original capital you invested. Instead, stick with high quality stocks that offer reasonable yields with sustainable dividends that are growing faster than inflation. I've invested in stocks all over the yield spectrum. Indeed, my portfolio currently has stocks with yields ranging from less than 1% all the way up to nearly 10%. But my best investments over the last decade have been stocks that offered initial yields in the 2% to 3% range, growing at a high single-digit rate or better. Almost every time I went after a stock with a super high yield, I got burned. There are some exceptions to this where a temporary dislocation can lead to a high quality stock offering a yield that's 4, 5, or 6 times higher than the market, but these would be extraordinary circumstances. Most stocks offering an extremely high yield will almost certainly not do well over the long run. My fourth lesson: don't sell winners. This is a huge mistake that's easy to make, and trust me, I've made it. I've reduced positions in great businesses over the years, usually because I was concerned about overvaluation at that time. I'll give you an example. I reduced my stake in Digital Realty Trust Inc., stock ticker DLR, in September 2017 when the stock was around $118 a share. I thought the stock looked overvalued at the time relative to business performance. Indeed, I could make a case that it was overvalued, but look at the stock now. It's coming up on $140 a share. It'll likely exceed $150 a share before you know it. The dividend keeps on flowing and growing, and I own less of this amazing business than I did before. To be fair, the stock didn't do much for a period of years after I sold it, which relates back to my concerns about valuation and kind of validates my conclusion at that time, and I reinvested that capital almost immediately anyway, which has gone on to work for me. But valuation is more of a crystallized way of looking at ownership, which doesn't necessarily translate well to long-term ownership. I mean, there was probably a point in time at which Digital Realty Trust stock looked overvalued at $30 a share, and there will almost surely be a point in time in the future, assuming the business continues to do what it's been doing, that the stock will look undervalued at $200 a share. Using short-term valuation concerns to justify a long-term ownership position is a mistake if the business is truly high quality. Digital Realty Trust is only one example of this. I've reduced stakes in or completely sold out of a number of great businesses over the years due to short-term valuation concerns, and many of these stocks are higher now than they were when I sold. Of course, my portfolio has well over 100 high-quality dividend growth stocks in it, so I'm not crying over spoiled milk, but the portfolio would be better off if I just let great businesses do what they do and stayed out of the way. The lesson here is to not get rid of your winners. Great businesses are tough to find, and you shouldn't sell out because they've run up. They often run up because of the demand for shares in great businesses. That's a sign things are working. While overvaluation can lead to a valuation correction in a stock over the short term, long-term winners tend to continue winning. Don't be short-sighted. Never let a chunk of a wonderful business leave your hands. Here's how the great investor Peter Lynch once put it: selling your winners and holding your losers is like cutting the flowers and watering the weeds. My fifth lesson: time in the market is much more important than timing the market for the long-term investor. I really can't overstate this point. It's a mistake that too many people make, and market timing is something I would sometimes uselessly concern myself with when I first started. Ignore the noise. Headlines will only serve to distract you from a basic truth, which is that high-quality businesses tend to make for amazing long-term investments. There will be bumps in the road, but the market has marched almost relentlessly upward over the last 50 years. Don't stress too much about what the market is doing today or tomorrow. Use volatility to your benefit. Short-term volatility is a long-term opportunity. Put your capital to work, keep up to date on what the business is doing, and go about your life. If you don't time the investment perfectly, that's okay. Our recent video on how to prepare for a 2021 potential stock market crash explicitly lays out how unimportant market timing really is. It's time in the market, which means you want to start doing your research today and get busy putting capital to work in high-quality businesses as soon as you're ready to. As Warren Buffett once said, someone's sitting in the shade today because someone planted a tree a long time ago. Get busy planting a tree, then start working on an entire forest. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these 5 lessons. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stock that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.